Hey, I had this brilliant idea, George, that because I've got this great interest rate on my house, that I could take out a home equity line of credit for a down payment on my next home and get cash flow and make my house a rental property. What do you think about that? Is that a great idea? Well, let's dive into the numbers and take a look at things. Thanks for coming into the Credit Jungle. This is George Anderson.
George of the jungle, strong as he can be.
I'm going to go through a very real scenario. In fact, I've had 3 different people tell me that this is what they've had buyers, potential buyers, tell them because they don't want to give up this great low interest rate that they got on their house when they refinanced it or purchased it maybe 3 years ago. So we've got a person here. We're going to look at 2 ways of doing this, okay? You can either be a landlord with your previous home or you can be a bank. And let's run the numbers and explain the benefits of a seller financing transaction for someone who might be considering this, who would like to move, but would like to maybe take with them some cash flow to help pay for that next house payment. So let's just assume that that loan taken out 3 years ago has a balance of about $350,000, 3.5%. The all-in payment on this one's going to be about $2,000 a month, okay? They want to go and finance $100,000 on their home equity line of credit, which they could easily do because you could take up to 90% of the value of this home. So if the home was $500,000, $450,000 would be the basis for that. The difference between $450,000 and $350,000 is the $100,000. So we're okay to get this line of credit. Prime right now is at 8%. You're not going to get prime, but let's assume that you could. If you could get a prime interest rate on that, the interest-only payment, nothing going to principal, is going to be $667 per month. Your payment now on your house is not $2,000 a month, but it's $2,667. I went and looked around a little bit. If we're just sitting there, saying in a nice neighborhood in West Jordan that is, let's just say the house has got 4 or 5 bedrooms and 3 baths, 2.5 baths, whatever, you're going to be pretty lucky to be able to get about $2,700 to $2,800 a month on rent for that property. And then what kind of a deposit are you getting? Well, you might maybe get another couple, $2,000, $3,000 of deposit on that. And now you're a landlord and you're sitting there in the lap of luxury with your previous home, maybe getting trashed by somebody who's got virtually no skin in the game so that you can make $100, $133 a month off of that. Let me suggest a better way to do this. And the other thing is that you're a landlord. You're not a bank. If you were to sell that home on seller finance, you can actually get a higher sales price than what the current value would be. And to find a buyer, and I could story after story, there's tons of buyers out there that have money. To get somebody that's got $75,000 to put down is not a big chunk of change. There's a lot of buyers out there. Some of them even qualify for a loan. And they recognize that being able to save $5,000 in closing costs and get a fixed rate mortgage that's at least 1% below current market right now, that's a good deal. So they're happy to jump on this, and then their payment with principal and interest and the same taxes and insurance that we had here would be added on over here. Their payment to you would now be $2,880 a month. Now, that's not much more than $2,700 a month in rent, but guess what you don't have? You don't have a payment on a second mortgage because instead of taking your money and borrowing against it, you used somebody else's money for your down payment. So how does that look on getting into your next home here? So let me turn around this way and go left-handed. So we're looking at a $750,000 home. Well, you could take the $100,000 home equity line of credit and you could put that down here, finance $650,000. Let's just use 6 and 7/8 as an interest rate. The rates have been moving around more than a bowl of Jell-O, but let's just use that. Your payment with mortgage insurance, taxes and insurance, your all-in payment would be about $4,875 a month. Well, the good news is that you've got $100 a month over here coming off of your landlord payment to shave $100 a month off of that. Not too good, and you may or may not have a cushion on there at all for vacancies and maintenance if it happens on this house. Now, on the other scenario where we sell our house and we become a banker, we've got a little bit less money to put down. And because of that, we're going to have a little bit larger loan amount. The mortgage insurance is also slightly higher, but you're going to have a $5,100 per month payment here, which is, $225 a month more. But what do you have? You have $880 a month in cash flow. So this payment, we can take off $133 from this payment. This payment, we take off $880, okay? Which situation ends you up with a net better position over here? Well, obviously, you're in much better shape here because you use somebody else's money to finance your down payment over here. Now, let's just talk about two other quick things here. Midnight Christmas Eve, the water heater goes out, you're going to get a phone call and you're going to have a service cost on repairs and whatever else is involved in that. Here, okay, if the water heater goes out on Christmas Eve, do you call Wells Fargo or Chase Bank and tell them that you need your water heater fixed? The answer is no, because they're the bank. They're not in charge of that. The seller finance buyer here is the owner of the property. Now, you're still on title. You don't have any risk with the, I don't want to say zero risk. You have a very, very low risk of anything to happen with the due on sale clause. But you've got a payment here with somebody that's put down a significant down payment on a higher sales price. Well, the situation here is that instead of owing $350 on your house plus the other $100, you owe $450 over here. Here they owe you $450. So on situation A, you have a $100,000 additional debt that is costing you 8%. Okay? On the banker situation over here, you have $880 a month of cash flow that you are receiving on the remaining equity that you have in this house. Well, what's your remaining equity? Well, the buyer owes you $450, you owe the bank $350. So you have $100,000 over here that is earning you instead of costing you $667 a month, you're earning $880 a month. And what is your rate of return? 10.5%. Banks make money by borrowing money at one interest rate and lending it out at a higher interest rate. You can be the bank on a transaction like this, and this is an infinitely better situation for you to be in, not only in the short run, but also in the long run. And when it comes down to the practicality, most people feel like it's a good idea to be a landlord until they actually become one and have their first run-in with evictions and trashed house and pets and whatever else you want here. On this situation, you have somebody in this house with an owner's mentality because they have $75,000 into it, not $2 or $3 grand. So hopefully this would help you make the decision. You want to call me and have me run the numbers. All I need to know is, what do you think your house is worth? And tell me something about your mortgage. Maybe have your mortgage statement handy. And this is a very good exercise to run through and see how you might benefit from this. There are so many buyers out there right now that are willing to pay this premium price for your home, come up with a large down payment, if you're willing to offer a less than market interest rate on this, because this, for this buyer here, is going to be a much better deal for them than if they went out and got their own financing. So thanks for coming into the Credit Jungle. Push button, get mortgage professional, and I hope to talk to you soon. Have a wonderful day. Take care.
George of the jungle, strong as he can be.